Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Wednesday edition of 7 Investing Now. My name, of course, is Daniel Brooks Klein. I'm the host of the program here in sunny West Palm Beach. Joining me from very thunderstormy Houston, Texas. I point that out because we could lose Simon Erickson at any moment, is Simon Erickson. And of course, Maxx Chatsko is in Pittsburgh, where it's cloudy with a chance of cheesesteak. Simon, welcome to the program.
Hey, Dan, how's it going?
So a little bit of a trivia question for you today to start the show, but I've moved up the list of famous Hofstra alumni. It was the person who died today, Ray Romano, then me, like not literally, but like somewhere in that. Simon, do you know who it was who died today?
I believe I do, Dan. I believe that Bernie Madoff was a Hofstra Flying Dutchman alumni.
Now talk about your mixed bag. You know when they say any publicity is good publicity? I'm not so sure that the guy who was the best at Ponzi schemes is really what you want to be proud of. Max, thank you for pointing this out. Max asked me earlier if we were going to have a moment of silence. We are not going to have a moment of silence for Bernie Madoff, but the first I knew that he was a Hofstra alumni was, of course, not when he was successful. It was when he was arrested.
So. No longer the Flying Dutchman either, right? You guys don't have the same mascot anymore.
No, now we are the Pride. And it's actually like severed my connection with the university. Like Hofstra dropped its football team, dropped its amazing nickname. A Flying Dutchman is a mythical ship in search of an unattainable goal. If anything described Hofstra sports, that was it. We basically peak once every 10 years, make the tournament, and then like get blown out by Duke by like 40 points in the first game. But we have a special show today. At the top, we're going to talk with Max about the pause in the Johnson & Johnson vaccine, what that means for vaccines, what it means for the economy. Not going to lord it over everybody that I've already been vaccinated, so I'm not that worried. No, just kidding. I am very worried about everyone getting vaccinated so we can get to normal. Then Simon is going to talk about the Coinbase IPO. This is not a company I understood very well, so I'm looking forward to this part. And then we have an interview with our very own Anirban Mahanti about hypergrowth investing. He explained investing to me in a way that basically when you look at a company, it is difficult to fathom how big. Like if you look at Amazon, from the beginning, you can't even do the math to where they are today. But with that, Max, are you ready to talk Johnson & Johnson vaccine?
Let's do it, Dan.
So before we get into this, we, of course, are a live show. We'd love your questions and comments. So wherever you're watching this, in theory, if you share a comment, we will see it. If you just want to say hello, we're happy with that as well. So Max, they've paused use of the Johnson & Johnson vaccine. Can you explain why and sort of what the near-term implications of that are?
Yeah, so regulators, the CDC and the FDA, decided to halt distribution at federal vaccination sites, and they did that hoping that states would follow suit, and many have indeed done so. So the reason for the temporary pause is that they've found, and they haven't linked yet, but they found at least 6 blood clots from women who have been administered the Johnson & Johnson vaccine. So they're just kind of taking this precautionary approach right now, and they're going to convene a panel to see what's going on and how to proceed going forward.
So the reason we bring this up is, of course, the faster everyone gets vaccinated, the faster we have a return to semi-normal. We don't know exactly what normal is going to look like because we don't know what variant. So it might be normal plus a mask. It might be normal with some capacity restrictions. But our good friend David Strauss asked the question on Twitter. This may come off as insensitive, but I can't believe this was stopped because 6 individuals out of 7 million people who got the shot ended up with a blood clot. I mean, that number is just silly. Nothing is 100% ever going to work, but nothing is 100% ever going to work. But to stop this for 6 out of 7 million is wrong. Max, that's not really what's happening here. This is a pause. It's not really a stop. Scientifically, what are they looking for here?
Yeah, that's right. So, I think it's important to point out just at the top, it's really easy in the moment to criticize or to take sides. And there's really no perfect solution here for regulators, right? If they kept going with it, there's a lot of vaccine hesitancy out there. It's kind of ironic, right? I cover biotech. My mother's actually an anti-vaxxer. So I have a good insight into that. I grew up in a household like that. So this has implications if you didn't stop if this worrisome safety signal came up and regulators just pushed and plowed ahead, that could be one tangible piece of evidence that could affect, vaccination rates for childhood vaccinations for maybe a generation, right? They have one tangible thing to cling on to and say, look, they really don't care about our safety. So a temporary halt here is probably the right move to do. Now, is it an overreaction? I mean, again, we're in the moment. You can take either side. So 1 in 1 million is basically the risk case or the rate that we have for blood clots from this vaccine that we know of. That's really very low, right? Women who take birth control, the rate is about 1,000 in 1 million for who can be at risk of developing a blood clot. And in cases of coronavirus that we've seen, the rate's 2,000 in 1 million. So the thing that the vaccine protects against, you have a 2,000 times higher chance of developing a blood clot than the actual, this one specific vaccine. So the rates are very low. And look, they're going to convene a panel actually today, this afternoon, of independent experts. They're going to look at all the data specifically for each of these 6 cases. And they're going to come up with a plan. Like, we know that there's a treatment plan for blood thinners for this. One blood thinner in particular is actually can make it more severe and actually can lead to fatalities. So we want to make sure we understand that and don't prescribe that if we do proceed, with vaccinations here. But the risk is overall very low. And, my hunch is we are probably going to be redistributing this by the weekend.
And Max, this is kind of about optics. So we talk a lot about autonomous driving. And let's say with regular driving, me and you driving, for every 1,000 people who drive, there's about, 30 deaths or accidents. If you theoretically, on paper, you could say, well, if autonomous driving cuts it to 10, that's an improvement of 20, and it's great. But the reality is, from an optics point of view, they're only going to accept 0. You can't say plane travel is 99.98% safe, because a plane crash is really graphic. So these are very, very public deaths, and they're not stopping this because of the risk. They're stopping it to figure out the best course of treatment. As you said, they don't want to give you the wrong thing. So this is just a pause. This is also a very small percentage of the overall vaccinations. The federal government has said we're still going to hit 3 million vaccinations per day, as they have been averaging. While we're closing out here, what is the difference between the Moderna and the Pfizer vaccine and the Johnson & Johnson vaccine? And then we'll talk economic impact.
Yeah, so in Europe too, we saw the AstraZeneca vaccine actually led to blood clots as well, and some concerns with that. So both the AstraZeneca and the Johnson & Johnson vaccine use something called an adeno-associated viral vector, an AAV, to deliver the therapeutic payload. The Moderna and Pfizer BioNTech vaccines use mRNA technology, which is relatively new. So an AAV is immunogenic. That means that which encapsulates the therapeutic payload, actually triggers an immune response. So that's not good for things like gene therapy. That's an obstacle for gene therapy because it degrades the efficiency of that tool. But for a vaccine, it actually helps. It boosts the immune response because you get an immune response from the encapsulation, the AAV, and then also the therapeutic payload once it's delivered. So that's why why Johnson & Johnson and AstraZeneca decided to go that route. But for whatever reason, it seems like there is this rare instance where blood clots can happen. And we've seen, interestingly enough, that most of these occur in women, right? The Johnson & Johnson vaccine, all the cases we know, all 6 are in women. And this kind of makes sense from a biological standpoint. Women, just like me, I have 2 X's in my name. They have 2 X chromosomes, Dan. Men, of course, have an X and a Y chromosome. But the X chromosome contains more immune genes. So women have a more active immune system. That's why they actually had less severe cases. They had less fatalities overall from the coronavirus. They also have higher rates of autoimmune disorders. So it's because of those 2 X chromosomes. So there's probably something linked to that. Are we going to tease it out at this panel this afternoon? Probably not. But again, there is probably something we can do. We're probably going to get this back into distribution here very shortly.
So Max, as we see vaccinations roll out, I think 3 million shots a day is pretty impressive. We've got 23% roughly of the country, I think, have received both shots. The number's a little higher when you add in people that have just seen one. Are we on pace to normal, or are we going to run into vaccine hesitation and not enough people being willing to take it, which in theory sets us back to square one potentially?
Yeah, I don't know. I mean, there's always going to be people out there who weren't going to take this regardless, right? And we've talked about this before on the show. I think the people who answer that question in a poll is higher than the people who might quietly walk into a Publix or a Walgreens or a Walmart and get the shot anyway, right? This kind of might complicate efforts, and because the Johnson & Johnson shot, by having only one dose and has advantages logistically with storage temperatures and distribution, the government and states were hoping to roll this out in like rural areas, places that didn't have the same infrastructure in place, right? So like a Walmart could distribute the Johnson & Johnson vaccine pretty easily, or even like a mobile clinic, right? And it's easier to do that than to sign people up for 2 doses, right? So that also lessens vaccine hesitancy. Easier to get 1 than 2. So that does kind of complicate it. But overall, like you said, most of the vaccines that are being administered right now are from, Pfizer, BioNTech, and Moderna. So the Johnson & Johnson still made up a very relatively small portion of that. Still important going forward, but I think overall we're crushing it in the United States. We're probably going to have an oversupply of vaccines. We've been saying that for a couple months on the show as well. And then we can export it for a little biodiplomacy, right? Countries that don't have enough or screwed up their own plans. Maybe Canada up there. We'll be helping you guys out too soon. Just sit tight. So I think all things considered, we're still in a very, very good position.
My good friend Jim Gillies, don't worry, we're coming. It's very rare the U.S. is ahead of Canada in anything, but we do appear to be winning here. I'm going to bring Simon Erickson in here because why are we talking about vaccines? It's not because Max is a biotech expert. It's because the vaccine will allow the economy to reopen. We're already seeing here in Florida a very strong trend of tourism, where some of it misguided, but you're seeing Disney bookings for the fall and the winter come in very, very strong. You're seeing the cruise lines post bookings for outside next year. You're seeing Airbnbs fill up because those are, generally safer. You rent a house with a pool where you don't have to interact with people. So as more people get the vaccine, I know the first thing I did 2 weeks post-vaccine, it was like 3 weeks post-vaccine, was I went to Las Vegas. And I think we're going to see that. That's going to be good for the economy. But I think it's important here, Simon, that people look at what a business did before the pandemic and use that as sort of the gauge of what it might do and kind of factor out that there's going to be a surge of demand. Like, yep, we all might go to dinner like as soon as we're allowed to. But do you think personally, are you going to travel more? Are you going to go out to dinner more often? I'm going to travel a little bit more because I have a year of pent up of demand and things to catch up on. But that's not going to be a long-term spike. Simon.
Yeah, I think you nailed it, Dan. I think that travel has been domestic picking back up and internationally still constrained. Countries are still putting caps on their borders. They're saying we got to get this under control. But you're starting to see these kind of regional booking sites, whether it's booking.com, whether it's China's trip.com, things like this are seeing upticks in domestic travel much more than international. And the real question for me is going to be business travel. I mean, are we still going to see direct sales reps out there doing meetings post-pandemic as often as they did before? That, of course, is a big thing. I think it is picking back up. We'll see if we get back to normal within the next couple of months.
So I'll answer this one because every time there's been a change in technology that makes offsite meetings easier, I remember back to the late 90s when I used to have to travel to an office to do a video conference, and they're like, oh, this is going to end business. No, it isn't. You know why people travel for business? Because they get to go somewhere and have a meal out and have some drinks at the bar. Is there going to be less travel? Probably a couple percentage points less. How will the airlines make that up? With luxury leisure travel. We're going to be more willing to take vacations and there's going to be a little bit more fear of missing out. We all missed out on a year. So I do think more people are going to worry about those experiences, are going to do that. I don't see a massive change in how we travel. There will be a spike. There will be some weirdness. And why do I bring this up, Simon? Because in a few weeks, it's going to be the first of the month. What happens in the first of the month? We release our new 7 investing picks to members. My pick next month, and I'm going to tease it without saying very much, some would view as a recovery play. I don't see it as a recovery play. I see it as part of one of these broad industries that has been disrupted because of the pandemic, that learned a lot during the pandemic, and then can capitalize on that. One I've talked about publicly that is not my pick is Southwest Airlines. Southwest Airlines was well capitalized, so they used the pandemic to add new routes, to go into new airports, to upgrade terminals at airports because their competitors couldn't afford to do that. That's where I'd look for opportunity. But Simon, if people want to subscribe to 7 Investing, They could, of course, just send me money and hope, but mostly there's a really good way to do that. How do people subscribe to 7 Investing?
Can I send you Bitcoin? Is that an option too, Dan? Do you accept that just yet?
We do not accept Bitcoin. I personally accept Bitcoin.
You got it. Okay.
There is a Bitcoin ATM. No, there isn't.
Duly noted. Yeah, thanks, Dan, for pointing that out. I'm looking forward to seeing your pick that will come out on the first of the month on May 1st. Max's as well. Everyone on the team. We publish our best ideas in the stock market, and you can access those if you want to sign up today at 7investing.com/subscribe. We also have I think something that's very unique, which is a subscriber call every single month. And we're doing that on Friday morning. So anybody who is signed up that sees our recommendations is going to have questions. It's going to say, Dan, what about this pick that you had? Or, what do you think about this? Or am I the right type of investor for that? And this is a unique way to get direct access to see not only how do we think about the picks and the information we write into those reports, but also have a back and forth conversation, which I think makes it a lot more comfortable and lowers the bar for actually taking action on figuring out if they're right or not for you. And so the first of the month is when our new recommendations come out. I'd encourage everybody that joins 7 Investing to attend our subscriber calls, which will be on Friday. And then if you're on the fence and you just don't know, hey, I don't know if I'm ready to take the leap into 7 Investing, Friday's 7 Investing Now live stream. You kind of an Ask Me Anything opportunity about subscribing or what we think about the stock market. Lots of questions. This is a long-term journey, not a short-term sprint. And we want to be there through all of it with you.
I feel like it's a club. It's being a member of a club. But unlike most clubs where I was a member of a country club and the lowest price membership was like $1,400, $1,500 a year, that didn't even get me golf and tennis access. We're charging $17 a month or $170 a year. I keep saying it, but this is a steak dinner for a taco price. Like, it is an unbelievable value, and that's intentional. We want new investors. Now, look, if you're a very experienced, very wealthy investor, we have plenty of those. There's multiple billionaires. There's multiple people who manage money. So people who are charging other people to essentially give them our advice. So we would love for you to become a 7 Investing subscriber. Daniel Kern, 79 says, is it Chuck E. Cheese? Chuck E. Cheese is actually no longer a publicly traded company, but I can guarantee that it would not have been Chuck E. Cheese. I can think of few companies that are more poorly run, to the point that Chuck E. Cheese caters to kids, has the Chuck E. Cheese facility, and at some point at night doesn't up the quality and become Charles E. Cheese and invite only adults in. And I'm not kidding. Like, when you own a building, you have to figure out how to maximize or rent a building. You have to maximize your revenue time. So when I used to run the toy store, we'd look at our not busy times and we'd, like, in the morning bring in like mommy and me reading, or come take a picture with the Easter bunny, or like whatever you could do to get traffic at times you're not busy. When I see a retail business not do that, or a restaurant not do that, I'm very worried. There's a reason Wendy's introduced breakfast, because you know what? It doesn't cost a lot of incremental money to do. Be open more hours. So sorry for the rant there. We are going to pivot. Simon, you are going to talk about Coinbase. We will take your question, Zulfikar, at some point later on during it. But Simon, let me first ask. So Coinbase went public today. The target price was $250. They came out of the chute at $350. So this is going to change a little bit of our question. But before we do any of this, what the heck is Coinbase?
Sure. So this is kind of an exciting news because Coinbase actually did its direct listing this morning. And like you said, Dan, it kind of sets a reference price where it expects for shares to trade at. But it doesn't know that. And we'll get into the details of that in a second. But let me first address your question. Coinbase is a cryptocurrency exchange. And so you can think about this kind of like a stock brokerage like Schwab, where you can actually go and buy Bitcoin and Ethereum and all the other blockchain-based cryptocurrencies out there. This is kind of your one-stop shop to get access to more than 100 different cryptocurrencies. And they vet it. They do a lot of work to make sure that the transactions are secure. They hold your digital wallet. They do a lot of things to make sure that the retail individual investor can buy cryptocurrencies. But the interesting part, Dan, is that it's not just a Schwab. It's also kind of like Schwab combined with PayPal. Because in addition to having the brokerage where you're buying and holding onto cryptocurrencies, it can then facilitate transactions. Now, this is going to be really interesting because remember, Bitcoin isn't like a share of a stock. If I own Apple stock, I can't go out and buy something at Chuck E. Cheese with my Apple stock. But if Charles E. Cheese is going to start accepting Bitcoin, I can use the balance that I have within Coinbase to make transactions. And that commerce side of the business is still very small compared to the retail trading side. The majority of revenue today is coming from commissions that is charging per trade, but we could see that evolve with some optionality over time.
Simon, is the big advantage here that Bitcoin and other cryptocurrencies are generally tricky to keep track of? You need to keep your digital key, and Coinbase sort of gives you a fail-safe way to not misplace your asset. Is that correct? A correct reading?
It is. Its security is the biggest question for the less sophisticated retail investors in this, right? So if you really have been following Bitcoin for years, you've got your own wallet, you've got to know how this goes. You might not need something like Coinbase. But if you're someone like my mom who wants to buy Bitcoin, she might not know all the details of how to do that in a secure way. And so what Coinbase did is it really got retail investors, individual investors, a way to do this securely and safely. It's got more than 43 million accounts, which is huge, by the way, Dan. A large stock market brokerage is typically between 15 and 20 million users. And this is global. You know, cryptocurrencies don't have to worry about remittance fees and foreign exchanges and all of those kinds of things. This is something that could get much, much larger over time. And there's one other thing I'd like to point out too, that this is not a traditional IPO. This is a direct listing, which means that the insiders of Coinbase are selling their shares directly to the public markets. Typically in an IPO, you have an underwriter, a Goldman or a Credit Suisse or someone that buys all of your shares, says, okay, here's your check for the shares that we just bought, and we're going to release them to the public. They take on the risk of how that trades on the first trading day and subsequent days thereafter. But in a direct listing, the company is basically saying, we're going to take the risk. We're going to offer those directly to you. Happens much more quickly most of the time and at lower fees than a traditional IPO. And so the direct listing is actually what we're going through right now. So there's a lot of volatility on that share price on this first day of trading.
It's also important to know that a direct listing does not raise any money for the company. And usually there's a subsequent listing. So that is important to remember, because this stock, direct listing at 250, was trading at 350 right out of the gate. If they do a secondary listing, which they almost have to do, because their last valuation they raised money at was $8 billion. They're now worth something like $600 billion based on this. But Simon, you actually don't think they're actually hitting their ceiling. You actually think it's worth more than it's trading at right now.
Yeah, this is actually something that I've updated my thinking on within the last 45 minutes. to be honest, when we started this morning, you know, there was the chatter that the direct listing reference price was going to be at $250 a share, which was the equivalent of a stock market valuation of around $66 billion. And I said, wait a minute, if that holds, these are a buy. You know, that is 20 times the earnings that they've got. I believe it was something like 10 times the revenue, and we haven't even gotten started with cryptocurrency trading yet. And we definitely haven't gotten started on actually using transactions. But you see, companies are starting to explore and innovate this, right? I mean, Elon Musk has now said, you know, he's bought $1.5 billion worth of Bitcoin, put it on Tesla's treasury, which means he's benefiting from the increase in the price of Bitcoin every single day. But then he's also saying, hey, we're going to figure out a way that you can buy a Tesla with Bitcoin. And Michael Saylor and, you know, the consultants of the way from MicroStrategy, the people that are really convinced in this long-term trend are enabling those innovators to get ahead of this. And so I still think we're in the super early innings. Dan, Steve and I just had Steve Symington, my colleague, and I just had a conversation with our partner Crypto EQ. We're going to publish that tomorrow for subscribers, just kind of exploring what is going on out there, not only in terms of the price of Bitcoin and any cryptocurrency, but how is this actually collision course impacting the equity world that we tend to play in here at 7 Investing?
So Simon, how vulnerable is Coinbase? Was at $100 billion valuation, which is probably where they'll finish the day. They're worth more than the New York Stock Exchange and NASDAQ put together. How vulnerable are they to traditional banks and brokerages paying attention to this? Like, I'm not going to join Coinbase if all of a sudden my brokerage at TD Ameritrade turns around and offers me the same features. Can the disruptor be disrupted here?
It can, and it will be. And this is something that's continuing to bring a lot of competitive attention right now. The traditional example, I guess, the history that we've seen, at least in stock market brokerage, has been consolidation, right? If you had an account with a smaller brokerage 10 years ago, it probably changed names on you 3 or 4 times, but your assets were still there, your stocks were still there. You just had to change your login to a different platform. And we also saw commissions fall more and more. Discount brokerages were $50 a trade, and then they were $20 a trade, and then they were $7 a trade, and now there's no commissions. And you're seeing the Robinhoods and basically every discount brokerage giving free transactions today as they find other ways to capitalize on this. And so the competitive threat for Coinbase, as you mentioned correctly, potentially being disrupted, is it's charging between 0.5% and 1.5% of every transaction. And so what that means is as the price of Bitcoin continues to go higher and higher, the transactions go higher and higher, and Coinbase's revenue goes higher and higher. That's why, Dan, we saw their first quarter revenue, the most recent quarter revenue, was more than all of the previous year's revenue combined as Bitcoin continues to climb higher and higher. So the question is, one, do those fees come down as competitors enter this space? And two, does the price of Bitcoin experience a significant correction, which means that revenue falls because the price is lower? Both are on the table, but on the other hand, counteracting that, we're still in the earliest stages of cryptocurrencies.
And Sam Bailey, let's take the first question from Zufkar to get towards closing this out. What advantage does Coinbase have over trading apps such as Robinhood? Once I see its accessibility, since Robinhood is open to international investors, boy, I wouldn't buy something volatile and ethereal in Robinhood. That seems to be like a terrible idea. Like their customer service is terrible. But Simon, feel free to jump in.
Yeah, switching costs, Zulfikar. I mean, the question here is, who else can scale to 43 million users as quickly as Coinbase did? And so Coinbase has got a huge head start that it can start expanding to offer new things. So Coinbase has now got a Coinbase card. It's going to look like a debit card, if you can believe this or not, that you can actually pay for things with Bitcoin. If you think Bitcoin's overpriced right now and you're like, hey, this is great, I've gotten a 10x return on my Bitcoin in the last couple of years, I'm going to use it to go buy a new car right now. I'm going to buy a Tesla because Elon wants to accept Bitcoin now. You can do that. And that's a lot more volatile for good or bad than the cash in your bank.
Can you imagine the buyer's remorse of like you buy a $45,000 Tesla with Bitcoin and then like 2 days later that money would have been worth like 70,000? Like we've talked a lot about when you sell your stocks, and yeah, occasionally you sell a stock and for some crazy reason it goes up 70% in the next week, but that's not typical. Bitcoin has been very, very volatile and will continue to be very, very volatile. We have a great comment from our very own Ashley Wilson, and then I will give Simon the last word. Max, if you'd like to read this comment, that would be great.
Yeah, Ashley says, Coinbase has a phenomenal platform. You can earn altcoins for participating and learning more about the underlying tech. There's also instant trading up to $25,000 on linked accounts. It's easy and powerful. That's actually pretty nice advantage there, right? Like instant fund settlement. Obviously for brokerage is not always the case, right? You got to wait a couple days or hours. It's kind of annoying sometimes.
And Simon, that's one of the opportunities you see here, correct?
It is. I think that kind of, if we want to pull this all together with some final thoughts on Bitcoin and crypto and Coinbase, we tend to like to look at this in terms of the bigger picture. You've got a company that's executing very well. It's got 43 million people on it. It's now gone public. It's got a lot of momentum behind it. But bigger picture, cryptocurrencies, the market cap of cryptocurrencies globally is around $2 trillion right now. Take all the Bitcoin, all the crypto, all the Ethereum, everything out there, put it together, it's worth about $2 trillion. There's about $10 trillion in gold globally. There's around $100 trillion in equities globally. And so what bigger picture, I mean, can we get to $20 trillion of cryptocurrency? And then are we actually going to start facilitating trillions of dollars of Bitcoin transactions in the future? If yes, if we do, then Coinbase is a huge winner from here. And if institutional funds, that have got the target date funds, Fidelity has got your retirement fund and a 401k, you've got, your money parked in assets like these. I mean, these are up to $1 trillion funds, right? Vanguard Total Stock Market Return is a $1 trillion asset fund. If they can convert the balances that are in cash, that are in money market funds, perhaps in bonds, over to cryptocurrencies, and people are really, really wanting to ride this trend, then it's game over. I mean, then anybody who is a bear on Bitcoin and saying that the price of Bitcoin is going to crater has been proven wrong, because the price goes through the roof when you're starting to talk about trillions of dollars with a T. So a lot to watch. There's obviously a lot of risk, but the long-term investor in me is very intrigued. Dan, this is kind of why we like chatting with Crypto EQ about this so much. It's a huge trend that's just growing in relevance over time.
I actually think this is a market that is going to accommodate the traditional players without particularly harming Coinbase. There is absolutely a class of investor that wants to buy into this, that's going to do it from existing platforms. We saw Jamie Dimon talk about it last week, that they have to spend, he's the CEO of JP Morgan, that they have to spend money to compete with fintech. They know they have to do that. So Coinbase will have competitors. And Mike Fee, I'm not taking your question because I haven't done the research on the alternative to Coinbase you're talking about, but we will look it up and talk about it on future shows. There's going to be upstart competitors. There's going to be established competitors. We're going to follow this one. But now, as we move into the next to last segment of the show, I did an amazing interview, Simon. I'm looking forward to you guys seeing this with our very own Anirban Mahanti about hypergrowth investing. I didn't even really understand what he meant by hypergrowth until we actually talked about it. We're 50-50 on whether this works. Sam Bailey, if you could hit that video now, go. Anirban Mahanti, welcome back to 7 Investing. Now, we always have to ask this question because as Americans, we have no concept of the rest of the world. What time is it in Australia as we tape this at roughly 6 o'clock Eastern time here in the United States?
It's becoming 8 a.m. here. So it's not that bad. It's actually nice and bright and well, almost bright and sunny outside. So early in the morning. So next day, the future.
We're going to talk hypergrowth investing. Before we do that, you've lived all over the world. You've lived in a whole bunch of different places. What is the one thing when you're in Australia you miss? And I'll give you a minute to think about it. My aunt, when she lived in Australia, she lived in Sydney also for 20 years, like from the point I was like 13 to maybe, my mid 30s. She missed a specific brand of vanilla pudding that you could not get. So we used to send it to her by the box. What is it you miss the most being in Australia that maybe you had in Canada or one of the other places you lived?
No, nothing specific about food. One of the things, when I lived in Calgary, I used to go to the Banff National Park and Lake Louise quite often. That's one of the most prettiest places. Now, Sydney is beautiful. Got oceans that you can see and beaches and so on. But so I sort of miss those mountains and the mountain hikes. So that's probably one of those things that driving in to the national park and just going for a hike. It's relatively easy access from Calgary. So yeah, so when I was in Calgary, that was one of the things that I would say I miss even today.
We're going to talk about hyper growth investing. So you wrote an article, these are your words, an article about lily pads and hyper growth investing. I'm not entirely sure what that means or where you're going with that.
Yeah, so the thing with lily pads is, people use the lily pads example for as a way to show how compounding works. And often what happens is you have a pond or a lake, there's like one lily pad, one leaf somewhere, then soon there's 2, soon there's 4, soon there's 8, and very quickly the pond can actually fill up. And often what happens is if you ask someone when the pond is half full, when is it going to become full? If it took say 15 days to get half full, people will say, another 15 days to get to full. But typically, compounding doesn't work that way. Compound is not linear, but our minds are used to thinking linearly. So the right answer is if it's half full in 15, in the 16th day, it should become full. It's just a way of play tricks with your mind, but that's exactly, I think, what happens when we think about disruptive growth companies and their growth. We tend to have problems in terms of thinking exponential. So and by that, take a company that's growing at 30%, right? If it's growing at 30%, it's doubling every 2.5 years. We have a problem starting to think that this can actually continue for a decade or more, right? And it becomes worse if you think of even higher growth rates, So take Teladoc as an example. If it's growing at 100%, we really have trouble thinking that this thing can actually grow at that rate for a few years. Because if 100% over a few years, it's a lot of, compounding that's happening. So that trips models, and it's a big deal because that's how you get a lot of undervaluation. What people think is overvalued is actually undervalued because I think this exponential growth is not captured. So I don't know if that made sense.
Yeah, to put this in perspective, if you've ever seen a virus movie or a zombie movie, this is the scene at the beginning where they show the red dots on the map. And like 5 days in, it gets to the point of no return if you don't slow down the spread. So like it is a difficult number, because the other thing we question is whether that growth can continue to happen. There's a lot of examples where it has, but I think if I told you 15 years ago Amazon was going to be as big as it is now, I don't know that the human brain can get its head around exactly how that happened. Sort of how do you as an investor look at this and go, okay, this is $1 million company, but they're growing at this rate. Here's why I believe they can get to some unfathomable number when it at least comes to my brain.
So, I'm just going to do a quick detour. Recently watched Contagion, on Netflix. And a fantastic thing to watch, which just seemed like the entire COVID-19 pandemic was done. Somebody had the template for it many years ago. So, and exactly that sort of thing about virus, like one virus, then two virus, and how they showed the origin of the virus. So that's fantastic. Good example, actually. Very, very timely, I would say, using virus as an example for hypergrowth. So here's the deal, right? I actually go back in history. And the reason I like this Lillipad article. I was doing some research. I looked at Walmart. And between 1985 and 1995, you'd be surprised, Walmart grew every year at 25% or more. Sales were around $6 billion or something like that, $7 billion in 1985. And they were like close to $90 billion in 10 years, right? That's the power of compounding. So the thing is that there is always an opportunity to compound if you come into a market with a different tack, with a different angle, with something innovative, right? So Walmart has been an innovative business. It was superbly innovative, this hubs and spokes model. It's way the disruptors are mom and pop stores. And there's somebody who's always getting disrupted, right? So they disrupted mom and pop stores. They did these, big centers and smaller centers and so on, right? And then they sort of applied the same idea internationally, first in the US, then applied it internationally. Amazon is basically sort of disrupting them. And the thing to realize with disruption is it doesn't necessarily mean that the old thing dies, right? Amazon has not killed Walmart. It's just Walmart's growth rate has eventually slowed down. It's not growing at 5%, 6%, right? The thing to keep in mind is, I just look at Walmart and say, well, okay, think about somebody building a model for Walmart in 1985. They would have a hard time putting in 30% growth rate for 10 years. And after 10 years, they would definitely put a terminal value. And this is the reason I'm pointing this out is most people, we build DCF models. When we build discounted cash flow models, we start with the revenue at the top, and then we go down, figuring out what the cash flow should be. But we have to model the growth of the revenue. And we would be uncomfortable putting a 30% growth rate for first 10 years and then saying we're going to now put maybe, and even if we do that, we're going to put then a 5% growth rate for the terminal value, which is essentially year 11 to infinity. But here's the thing, right? Walmart actually then grew at 10% or more for the next 10 years, right? Eventually they then slow down. So things can actually, if they're great businesses, they can grow for a long time. So I actually let history be a judge. Number two, I look at past, if a company is growing, and this sounds obvious when you say it, but it's very difficult to do. If a company grew at 100% last year, it's not going to grow at 20% next year, right? If a company grew at 80% last year, it's not going to grow at, 10% next year, right? It's going to grow at some rate. And you just have to bear in mind. And then the third thing I try to do is I am happy to be wrong. So, and that's very important. If you're happy to be wrong, then you're willing to take these bets. And these bets are great bets because they're often underpriced for the future growth because people just don't think exponentially. So that's sort of how I tackle this.
So I'll point out that Walmart has been a constant innovator because Amazon did kill Sears. I mean, there's still technically a Sears, but it's a shadow of what it was. They've crushed JCPenney. I talk about this a lot. There's a lot of retailers out there that simply thought things were going to be the way they were, and that's where the ability to grow came, from. Now, of course, Walmart and Amazon have also created their own markets. Is there a point with scale where all of a sudden you're rolling downhill, where if you're Amazon and you right now decided to go into bowling balls or golf clubs or whatever it might be, pretty much you have the scale to do that. I mean, they've struggled with apparel and a few things that need exposure, but in a lot of areas, basically Amazon or Target or Walmart can just be like, okay, we do this now, and they're instantly a market leader.
Yeah, so I purposefully was talking about, I knew that you love retail and then get your retail juices pumping. So that's why I picked retail as an example. But, I think you bring a great point here, right? So the willingness to innovate is great. And once you have a big customer base, you can really innovate in different ways, right? If customers trust you. So Walmart clearly has been innovative because Walmart's actually online business is growing very quickly, right? So I guess the two things is, if you have a big customer base, you've got scale, you've got opportunities. That's very important. But to get there, you have to grow quickly, which is why you said a lot of companies tend to lose money in the beginning because they're trying to get to that customer base, which gives them optionality. The other thing really is the constant innovation, which you already pointed out, right? Constant innovation is what actually saves you from death, the eventual death. Like, at some point you stop innovating and then there's a problem. Innovation also doesn't have to be like rapidly dramatic, right? It can just be incremental innovation. Incrementally better products make us happy, right? We're still happy with Walmart because it does, provides you good price for the stuff at all at nice places, and it's great. So I think, and then willingness to fail.
Let me jump in here because there was a major inflection point with Walmart where Walmart bought Jet.com. And it had to make the concerted decision to empower Mark Lowry, who was the CEO of Jet.com, to lose billions of dollars in re-engineering the Walmart supply chain to work for digital. Basically, he had to sacrifice every lieutenant who worked for him and more or less engineer kind of his own way out of the company to get everything that needed to happen. Doug McMillon, the CEO, it took courage to give up sales now. That's the same thing Disney did. When Disney started Disney Plus, Bob Iger called all of his department heads into a room and said, you're going to lose money at box office, you're going to lose money at all of these different areas to sacrifice to grow this new thing. And obviously that paid off very quickly because of the pandemic, which it wouldn't have otherwise. But I do think your Walmarts, even your Amazons, will going forward still have to have courage in order to grow. Amazon's always showed a willingness to do that. Walmart, there's going to be a book written about that couple of year span.
Absolutely. I think Walmart is fantastic. Actually, Walmart is a great example of an old company, really old company that has been constantly innovating and changing with time. So that's, I think, the most important thing: willingness to change with change in time. I think the thing is that exactly Sears is no longer there because the thing is that Amazon's business, if you think about it, is not primarily or Walmart's business. Amazon is basically trying to go online. These guys have been big on offline, if I may use that word. And often innovation happens. Often the big innovation happens in completely different, dramatically different markets, right? So you're not going to disrupt social media by trying to be Facebook. Social media can get disrupted by something that we can't even think of, right? That's the sort of the step change. And the other thing is that when the market becomes big enough and established, like the example you brought about, you mentioned about Disney, right? The players with a lot of balance sheet power and staying power with a lot of consumer appeal, they can actually pivot, like Disney Plus. And that doesn't necessarily mean that Netflix is going to die. It's actually just basically says that market is now fully established and not there, like 4 players there. So I think that's the fascinating way of thinking about it. I think a little bit of optimistic feel that the world is going to be better in the future, and the companies that make our future better are actually going to be the ones that succeed, right? And Walmart is clearly doing that. Netflix, Disney. So that's the way I like to look at it.
And it's worth noting that Disney Plus has killed some of the second tier players. WWE Network no longer exists in the US as a standalone entity. It's now content on Peacock. Because I do think you're going to see some max for people of, I only need so many of these. Now, Amazon is pivoting in an interesting way. They're going to launch thousands of traditional grocery stores. And why are they doing that? They have the supply chains. It is a great time to be renting grocery store, that size of store. The prices are going to be good. And that increases their distribution market. So they're going to open physical stores that make their online stores stronger. Again, it becomes that ball rolling down the hill. Let's close out here with what are you watching that's Amazon-like today? Tell everybody, that's why people are watching. They want to know, I say buy Amazon. I think there's a lot of room to grow there. But that said, Amazon's not going to, as a stock price, be a 10-bagger over the next 2 or 3 years, most likely.
Yeah, so like I own Amazon, have not sold the share. Here's the thing, right? So I think I had a tweet storm about this, that we think of a $1 trillion company as too large today, right? But the average S&P company today is about $70 billion on average market cap. 30 years ago, there was about $6 or $7 billion. So market caps expand over time. So Amazon can become much bigger over time. But one company that I think people are sort of underappreciating, and I've said this, Tesla, which is code is TSLA, one of my family's largest holdings, and I've stopped I don't think I'll ever make this an official recommendation because it's just a difficult stock to, it's one of those stocks that is very difficult to convince people. But Elon Musk comes out and says, we're going to grow volume by 50% for the next decade, right? Just do the math of that. That's compounding, serious compounding. Nobody believes him. Nobody believes that they're actually going to do that. But if they do that, this thing is, actually cheap. And in many ways, in the way I look at Tesla is, if you go back in time, similar point in time to Amazon, Tesla is actually gap profitable, cash flow generative compared to Amazon, right? Tesla actually has a PE today. And if you look at its forward PE, it's actually not that bad. So, and the forward PE probably is underestimating its real earnings. So I think that's one company that I would say can be significantly larger over time. And I think the other thing we need to realize is we should really not think about market caps in terms of today, right? We should really think about what market caps can be in the future. So I think there's a little bit of, thinking that we need to do, which is different, like from what I think the conventional wisdom is. Conventional wisdom would be looking back, in time, these companies are so large, can they get any larger? And the answer is yes.
So this is why I'm so excited that Anirban is here, because when you look at a company, companies will tell you their total addressable market, but total addressable market's a meaningless statistic. It's like saying, hey, I could be the Chipotle of Chinese food. And sure you could, but your odds of getting there are not high. But when you look at whether it's a mature company or a growing company, you have to project out 10 years of what their business might be. And that literally means it might be something entirely different than where it is. I don't think too many people, when they looked at Amazon, in the first couple of years it was public, went, what'll be a big driver here? The cloud, web services. Nobody saw that. People, when they were a bookstore, might go boy, I bet they could sell CDs, maybe posters. It is a big leap to get where they are. And I think when you look at any of these successful companies, it is what's next. You look at Tesla. Would it be crazy to you if Tesla became like Richard Branson's Virgin? A Tesla cruise line isn't out of the question. A Tesla, whatever, that brand means so much that sure, they can exploit it with merchandise, but they can also open Tesla rides as a licensed ride at a theme park. And that won't necessarily be driving a Tesla. Who knows? But when your brand is that powerful, your ability to sell Tesla frozen yogurt is strong. I don't know what that would look like, but it would be a way to pass the time at the charging station. I'm being silly. Anirban, thank you for getting up early with us. And I guess I'll throw it back to myself. And we are back. I am impressed that worked. Sam Bailey behind the glass. Thank you for that. We're going to take Dee's comment. Dee says, Anirban has been a great addition to the team. Yes, he has been. Behind the scenes, in front of the camera, we had a ton of fun taping that last night, and we fought through some technical problems. There's koala bears all over the internet there. I'm not sure what it is, but it doesn't actually, we had a lot of glitches, so that took a bit to get to what you just saw. But with that, Sam Bailey, we're up on the top rope. It is time to hit our finisher. Which is the strongest brand for the next 30 years? Overwhelmingly, you said Nike, almost 68%. Lululemon came in third at 11.3%. Peloton at 13.7%, and Levi Strauss at 7.1%. Simon, can I make the argument that 30 years from now, I'm 100% sure that there will be Levi Strauss jeans, and I am not 100% sure about any of the other ones there? I actually think there's kind of some recency bias on this one.
That's interesting, Dan, because I also voted for the minority on this one. I almost certainly think that the answer is Lululemon. When we think about the power of the brand, allowing for pricing power and how strong Lululemon has that figured out with their audience, I would personally have voted for B in this one.
That Max, have you heard of all of these brands? I know you're familiar with Nike, but is there one you'd pick here?
Yeah, I would agree with you. Maybe there's some recency bias. I would say Levi Strauss definitely going to be around 300 years from now. We're going to be wearing those on Mars probably. But yeah, Nike, like, I don't know, how do you pick against Nike, Dan? Is it?
Yeah, here's the thing. I actually think all of these are going to be long-term foundational brands. I don't think it's out of the question that there's some consolidation. It wouldn't shock me if somebody bought Peloton at some point. I know that's a very expensive purchase. Lululemon, same thing. The power to make Lululemon beyond an athletic brand is very strong. There could be a Lululemon food line in Target. Like, that's not a crazy thing to think about. We have run out of time. Let me give a little tease for Friday's show. On Friday's show, I'm going to have the entire team, and we're going to be taking your questions. So if you'd like to get a question in, hit us up at our Twitter. That is at 7investing. I'll put a call for questions up at some point today. I'm going to go to the pool after this, but after that, I will put up a tease where you can ask us questions. We'll talk about anything. Of course, if you're a member, we won't talk about recommendations. We'll do that in our members only call that takes place at 11 o'clock. And you should also remember that Friday's show starts at 12:30. It is a different time. If you have questions for us, you can reach us at I'm going to take a drink here. info@7investing.com. Dry throat just hit me all at once. info@7investing.com. That's questions about the service. That's questions about your membership. And of course, we're available on Twitter for anything you like at 7investing. That brings us to the end of the show. Apparently the end of my voice. For Simon Erickson, Maxx Chatsko, Sam Bailey behind the glass, we appreciate you watching. We will see you Friday at 12:30. Thank you.